All right, let's talk about Affirm. We're going to dig into their latest shareholder letter today, and honestly, there's one thing that just jumps right off the page. A massive, massive swing to profitability. So how they do it? Well, we're about to break down the numbers and find out. Let's get into it. Okay, so right out of the gate, this is the number that makes you stop and go, whoa. Just a year ago, Affirm was in the red with an operating loss of $133 million. Fast forward to today, and they've completely flipped the script. We're talking about a $64 million profit. That isn't just a small improvement. That is a dramatic reversal.
So the big question is, how on earth do you pull off a nearly $200 million swing like that in just 12 months? It's not magic, right? It's a story that's told in their key metrics and in the strategic choices they made. And that's exactly what we're going to unpack.
All right, here's how we're going to tackle this. First up, we'll look at the big turnaround itself. Then we'll dive into what's actually fueling all this growth. After that, we got to ask, how do they even make money? Then, critically, are they keeping their risks in check? And finally, we'll see what Affirm itself thinks is coming next. Okay, let's jump right into section 1, the big turnaround. This is really the headline story here, right? The journey from burning cash to actually making a profit. Yeah, look at that number, $196 million. That's the year-over-year improvement. And to really get how a number this huge is even possible, you've got to understand the two metrics that are like the engine of Affirm's entire business. So first up is something called GMV, or gross merchandise volume. Look, the easiest way to think about this is it's the total price tag of everything people buy using Affirm. You buy a $1,000 couch with Affirm, boom, that's $1,000 of GMV. It's really just a raw measure of how much stuff is being processed through their system.
Okay, so that's GMV. The second, and maybe even more important term, is RLTC. That stands for revenue less transaction costs. So going back to that couch, RLTC is the actual profit Affirm makes from that sale after they pay for all the direct costs, like the cost of borrowing the money and covering any potential losses. This is the number that tells you how profitable they really are.
All right, so we've got our key terms down. Now let's move on to section 2, fueling the growth engine. Because look, being profitable is one thing, but you can't get there without some serious growth. So where's it all coming from?
And wow, the growth is not small. Remember GMV, the total value of all the stuff people are buying? Get this, $10.8 billion in a single quarter. That's up from $7.6 billion just a year ago. That is a massive leap. So what exactly are people buying with Affirm that's driving this?
So if you take a snapshot of their business right now, yeah, the traditional loans, the ones where you pay interest, they're still the biggest piece of the pie, a huge 72%. And then you've got the zero interest stuff making up the rest. But this chart right here, it's kind of misleading. It only tells you what is, not what's growing. Okay, this is where it gets really interesting. Yeah, their classic loans grew by a solid 35%. That's pretty good. But look at the other two. Pay and X is up 55%, and their monthly 0% APR loans, they just exploded, up 74%. So you can see the strategy here, right? They're using these super attractive, no-interest offers to just pull in tons and tons of new customers.
Which leads us perfectly into section 3. How do they actually make money? I mean, you hear 0% interest and you have to wonder, where's the profit? So let's pop the hood and take a look.
So Affirm's money comes from 4 main places. They get interest income, of course, they get network revenue, and servicing income. But look at that top one, gain on sales of loans. That grew by a whopping 87%. This is a huge part of their model. They make loans and then sell them to other financial partners. And they got way, way better at it this year.
And this all circles back to that key metric we talked about, RLT. Their RLT as a percentage of all that GMV came in at 4.2%. Now, I know 4.2% might not sound like a lot, but here's the kicker. Their own target for the long run is between 3 and 4%, so they're not just hitting their goal, they're crushing it. They're running leaner and meaner than they even planned to, and that efficiency is a massive part of this whole turnaround.
Hey, just a quick aside here to keep things super clear. You're going to see 2 different terms for profit. There's operating income, that's the official by-the-book accountant-approved number. Then there's adjusted operating income. That's a number they calculate to show you how the core business is doing, without things like stock-based pay. The good news for Affirm is that both numbers were way up, but it's just good to know the difference.
Okay, this brings us to a really, really important part. Section 4, keeping risks in check.
Because whenever you see a lending company grow this fast, a little alarm bell should go off in your head. You have to ask, is this growth real and sustainable, or did they just start handing out money to anyone who asked?
I mean, this is the big one, right? Are people actually paying their loans back? Do they have to lower their standards to get these huge growth numbers? Let's see what the data tells us.
And the first piece of news here is pretty great, actually. The number of people who are late on their payments, what they call delinquencies, that number actually went down compared to last year. That is a huge sign that even with all this new business, their system for picking who to lend to is holding up really well.
And get this, for those pay-in-4 loans, which are one of their fastest growing products, the expected loss rate is less than 1%. Let me say that again, less than 1%. For this kind of short-term lending, that is an incredibly low number. It's a huge vote of confidence in how they're managing their risk.
So, they had a great quarter, growth is booming, and risk seems to be under control. That brings us to our last section, what's next? Where does Affirm see itself going from here?
All right, so this is the company's own playbook for the future. You can see they're expecting that GMV number to keep climbing, both next quarter and for the whole year. But the really important part is that operating margin. They're forecasting over 7.5% for the full year. Basically, they're telling everyone, this profitability, it wasn't a fluke, it's here to stay.
So let's wrap this all up. It really seems like Affirm has cracked the code, right? They've found this amazing formula that mixes explosive growth with really smart risk management, and it led to this incredible turnaround. But the big question, the one everyone's thinking, is what happens now? The buy now, pay later space is getting more and more crowded every day. What's it going to take for Affirm to keep this incredible engine running? I guess that's the story we'll all be watching.